Un'urgenza, severa.
Thank you, John, again. So if there are questions from you, okay?
Two questions. The first is, we talked about HFT in the US. Why in Europe? Why hasn't happened this in Europe until 2007?
Yeah.
And the second question I would like to ask is about something you said yesterday. You said that political changes can affect considerably financial markets. Now, the date of 23 June is near, so how positive or negative results of the Brexit referendum would affect our economy?
Yeah.
And if I can ask, what's your position on the referendum?
Yeah, okay. Well, actually, the two questions have linked answers. So the significance of 2007 is MiFID, the European Union's directive on markets in financial instruments. Up until 2007, exchanges such as the Borsa Italiana had a legal monopoly of the trading of shares, and those legal monopolies became illegal after 2007. So Chi-X knew this directive was coming, so they got themselves in a position to launch immediately. The directive came into force. So that introduced competition among trading venues in Europe. And yeah, the referendum in the United Kingdom, I'm very strongly in favour of remaining in Europe for all sorts of reasons, some of them cultural, some of them political, but also things such as this, that the European Union has played a role in breaking down old established monopolies. So it's, you know, it's a role that I would support. If my compatriots were to be foolish enough to vote to leave, I would expect some disruption in financial markets, but probably not very serious disruption, because people are aware that there is a possibility. I think most traders assume that most likely Britain will vote to remain, but they all know that a vote to leave is possible. And generally speaking, it seems to be the case that the events that cause real disruption are events that are not anticipated, that something that people know might happen, they will be kind of prepared for. So the pound will fall, the euro will fall, the stock markets in the UK and in continental Europe will fall somewhat. But I wouldn't expect a financial crisis as a result.
Thank you.
I have a question to this one. So we have an impact of politics on economics. So my question is the reverse. So what is the impact of economics on politics? since as an average person watching the news, you can see, for example, all these very strict restriction that, for example, Angela Merkel is kind of imposing on countries, etc.
Yeah, yeah. Yeah, I suppose, yes, I mean, clearly economics and the financial markets have had major impacts on politics, most obviously, as you've just suggested, in the European Union. By and large, those impacts have come via markets in which high-frequency trading does not take place. So, clearly in Europe via the Eurozone government bond markets overall. So that the kind of markets that I've been studying, there is a very clearly a very generic influence of stock markets on the behavior of corporations, for example. But it would be difficult to draw any very direct connections in terms of the two-way interaction between markets and politics. In the domain that I've been looking at, the influence of politics upon markets is more easily discernible than the rather, the real but rather diffuse processes that go in the opposite direction.
Other questions? Okay,
Just,
Eugenia. Yeah.
Just one little thing. About Ireland.
Yeah.
We saw at the end that the New York Stock Exchange and the others had to change their structure for being more similar to Ireland because of the way the market changes. But at the beginning we saw that there's only one left office of Ireland and it's closed. So I was thinking what happened to Ireland?
Yes. That it was bought, first of all, by Instinet. It was bought by Instinet in 2002. Instinet is the abbreviation of institutional networks, and that was the other early share trading electronic venue. It's actually much older than Ireland, but as the name institutional network suggests, this was not for individuals to trade upon, this was for big institutional investors. And in the same way as Ireland got some of the market share of NASDAQ, it also encroached upon the market share of Instinet. But Instinet was an older, richer company owned by Reuters, the big news agency, so they simply bought it. And then in 2005, NASDAQ bought the joint company, or he's bought the US operations of the joint company. So Ireland begins as a sort of rebellion against NASDAQ. Then NASDAQ buys it. But what NASDAQ did was essentially to transform itself around Ireland, so that the matching engines of NASDAQ are basically derivatives of Josh Levine's matching engine for Ireland, and NASDAQ's data feed is Itch, which is the Ireland data feed, and the main, or at least the fast entry protocol is Ouch, which is the Ireland entry protocol. So it's one of those ambiguous events. On the one hand, the established order wins by buying the rebels, but the established order also has to transform itself to take on the characteristics of the rebellion.
First of all, sorry for the bad English that I'm going to use.
Well, I've already apologized for the fact that I'm talking entirely in English and not at all in Italian.
And talking about financial markets, aren't we betting on the spread of prices too much, or better, isn't there too much interesting on the speculation and not on the economic side of the situation? And another one, according to one of the previous questions, it's right that politics has a role on the market's choices and prices, but this role isn't become too much important, or the interaction between politics and financial markets isn't become too much important as previous of the 1930s crash.
Mm. Yeah. No. Yes, you're quite right. That by any reasonable standard, there is too much financial trading going on, and it is counterproductive even from the viewpoint of the investor doing the trading. It is profitable from the viewpoint of a high-frequency trading firm, but for the kind of institutional investor that, say, is operating for a pension fund or for a mutual fund, collective savings vehicle, most of those bodies do trade too much. They would be better off simply buying shares and holding on to those shares. And that's, of course, because the efficient market hypothesis of financial economics does actually work most of the time, and it certainly applies to institutional investors. They can't expect to beat the market. So yes, you're quite right, that there's too much fascination with trading and too much trading going on. And yes, absolutely, the ways in which the financial markets in the 1930s influenced politics overshadow anything that has happened more recently. My point really was more an analytical one. That's to say that to understand the kind of developments that I'm talking about, that even though my talk was exclusively focused on those two ecologies, that fully to understand the process, I would also have had to bring the ecology of regulation and the ecology of politics into it. I didn't want to make what was already a long talk longer by doing so, but that would be necessary and it would paint a full picture here.
Okay, I have a question. It's about HFT regulation.
Yep.
The first question is what regulation are still to be done? What should be done? And I've read that some propose a minimum time of holding of each shares. But what if that is the case that we should apply? What will happen then to the HFT market?
Yeah. What would happen? I think it's pretty clear what would happen if a minimum. Well, I beg your pardon. What I was going to say refer to something slightly different, which is a minimum resting time, which is a very common proposal.
Yeah.
If we go back to that picture of the book. If you think about the economics of market making, which is to say, the economics of a firm whose core business is to have that bid to buy and that offer to sell in the order book. What that firm hopes to do is to make the profit of a cent per share traded, the difference in price between the bid to buy and the offer to sell. The risk that firm runs is what in market making is talked about as being run over. That's to say, the equivalent of stepping into Rome Street and a bus coming along. So that there, in other words, there's a big move in prices, and the market making firm doesn't manage to cancel its bids or its offers fast enough. Yeah. So it gets, in effect, the same thing has happened to the NASDAQ broker-dealers. It buys shares as they're falling or sells shares as they're rising. And if that happens to you, that's described as being run over. The problem with the minimum resting time, the fact that if you impose this regulation that perhaps for a quarter of a second you can't cancel a bid or you can't cancel an offer, is that it increases the risk for a market-making firm of being run over. And so what market-making firms would do, they'd be kind of forced to do by the economics of the business, would be perhaps you would have order books in which there were no bids to buy at $44.99 and no offers to sell at 45, so that the spread would increase. So that's the problem with that approach to regulation, the very common approach, the minimum resting time thing. I mean, my own view about it, if one was looking for a limited reform that would make sense, is to follow the proposal of Eric Budish, the Chicago economist who I mentioned yesterday, whose the reference to whose paper was in the last of my slides from yesterday. What he suggests is replacement of continuous trading, because that in essence is what we currently have in this sort of market. You can trade at literally any point in time. Replacement of those by auctions that might occur every second, which doesn't sound like a big change, but it eliminates quite a lot of the advantages of speed, so that the kind of arms race I was talking about yesterday, desperately trying to get to the relativistic limit of speed between Chicago and New York, stops making the same economic sense in the auction model. So there I think there would be some, yes, at least if the model that Budish and his co-authors put forward is an adequate model, and it may or may not be, but if it is an adequate model, that would be a reform that would have positive economic consequences.
Other questions? Okay, maybe we have time to take all the notions of performativity.
Performativity, yes.
Yeah, maybe we could. Maybe some of you.
I had a kind of question about this. So, as you state in your book, models are engines and not cameras.
Yep.
But there is also some aspect of camera, because those people, I don't remember the name, that studied how to predict horse races outcomes. Yep. There are some kind of laws. I'm thinking, for example, about thermodynamics, that can somewhat have a camera-like model that is more general and higher level.
Yes, and I don't disagree. And indeed, the way to introduce the notion of performativity here is to go right back to David Whitcomb. So just let me recap for a second. So what we're talking about is performativity. So at the end of the world is going to disappear behind the screen, but I need the screen as well. If I say I apologise, as I already have apologised for talking entirely in English, not in Italian. I apologise is a different kind of utterance from if I say it is sunny outside. I'm speaking very simplistically, and I know a sophisticated linguistic philosopher would criticise me, will allow me to be simplistic. If I say it is sunny outside, that makes no difference to whether or not it actually is sunny outside. Whereas if I say I apologise, then by saying that, I perform an apology. I'm not describing some pre-existing or external state of affairs. I am doing an apology, creating an apology by saying I apologise. So I apologise is a performative utterance. And you're quite right that in the book An Engine, Not a Camera, I apply that notion which was taken into the study of economics by the French sociologist of science and economic sociologist Michel Canon. I take that and apply it to financial economics, looking at the effects of financial economics on the markets, looking at the effects on markets of the existence of models such as the Black-Scholes option pricing model that are models of those markets. What difference does it make to a market if there is a model of a market that isn't just restricted to academic classrooms such as this, but is actually used by traders in their trading, used by regulators in their regulation of markets, and so on. And I do think that that's an important process. However, I also think that one should not exaggerate the influence of academic economics specifically, because there are instances, and the Black-Scholes option pricing model is one, there are instances where academic economics has had a big influence on practices in markets. But those are probably empirically not very, very common. And indeed, if one looks at what Michel Canon writes about economics, it's very easy to misunderstand it, because people often think that when he talks about economics, he's talking about the economic discipline, about economics as an academic discipline, but actually he's using the term in a broader sense to encompass basically the material practices of economic life of a large variety of kinds, including accounting, for example, or marketing. Those both fall within what Canon means by economics. So you can kind of see this here, because Whitcomb, the kind of economics that Whitcomb does is market microstructure theory, and the core problem that the market microstructure theory studies is exactly the problem that I was talking about a couple of minutes ago, which is the problem of the market maker. So that the core modeling in market microstructure is how to model the market maker, the spread that the market maker puts on in the context of the risk of the market maker being run over. That's what models of market, or the core classical models of market microstructure theory are around. So when I first heard of automated trading desk and realized that Whitcomb was a market microstructure theorist, my first hypothesis was that its automated systems would be implementations of that model. And it's perfectly plausible because automated trading desk was largely an automated market maker, so it was perfectly plausible that it might be implementing models from market microstructure theory, but empirically it wasn't. As I said, the original inspiration was far more mundane. It was horse racing.
Yeah.
So I want to say something relatively nuanced here about performativity. I would want to say it's important when thinking about performativity not to think just about academic economics, to think more broadly about systematic material practices in markets. And if one thinks about systematic material market practices in markets, then what I've been talking about is indeed a study in performativity, because how share trading takes place in the United States and in Europe, to some extent, a bit less so in East Asia, in Japan, Hong Kong, Korea, Singapore. That trading, those markets have been utterly transformed by the material practices of high-frequency trading. So markets, those practices are indeed an engine. They've changed markets, but those practices, it's dubious whether one would want to call them economics in the academic sense of economics. It clearly, Whitcomb, it helped that Whitcomb was an economist, because if you're an economist, you do know how to write a regression model. So unquestionably he drew upon his academic training in economics, but the algorithms deployed by automated trading desks were not really implementations of academic economics. They were systematic material practices, but not economics in a narrow academic sense of the discipline. So sorry, that was a very long answer, but Emiliano wanted that question to be raised and answered. So
It's fine.
yeah.
Yeah, also because maybe thinking of academics, maybe we could talk about counter-performativity. Maybe, I don't know what you think about behavioral finance, behavioral economics. Maybe that could be an example of counter-performative model, because if I'm aware of all the errors and mistakes I could make as a human being, maybe I would push the market to be less and less human in a sense. I don't know what you think about this.
Yeah, no, absolutely. I mean, again, there are nuances here. Michel Calon doesn't really like the notion of counter-performativity, or at least he puts a particular twist upon it, because if you're an actor network theorist, then the entirety of reality is performed and performative. So the idea of counter-performativity is a slightly odd one if you're an actor network theorist, but we'll set that aside. And so, I would say that absolutely there are instances of both deliberate and, as it were, accidental counter-performativity in financial markets. I mean, my favorite one comes from the work of the famous chaos theorist Benoit Mandelbrot, and his original work on Phinance is on stable Levy processes. one exception, have infinite variances. And what that essentially means is that astonishingly bad and astonishingly good things can happen. There's no, it's not the Gaussian, yes, exactly. It's not the Gaussian curve.
The bell. What are you looking for?
I lost my chalk. Luckily, you probably kept an eye on the Thank you. Yeah, so it's not.
Thank you, Dad.
It's not the famous L-shaped Gaussian distribution, when you know that an event out here is vanishingly unlikely. That can always happen, or event, because anything negative tail that one runs about financial markets. That's vanishingly unlikely. A stable Levy process, no matter how far out you go, there's a non-trivial chance of something happening. It's horrible mathematically because all sorts of econometric, all sorts of econometric reasoning depend upon finite variances, and you get infinite variances. It makes life very difficult indeed. And curiously, I found that being used in finance by the Options Clearing Corporation. Which is the clearinghouse for options trading. And as I was saying yesterday, the one thing that must not happen in financial markets is that the clearinghouse fails. That is a catastrophic event in the financial market for a clearinghouse to fail. And what the clearinghouse does is to set the margin deposits. So the question that the clearinghouse's modelling has to answer is, how do you set, how big must the margin deposits be so that the chance of the clearinghouse failing is very, very, very low? And it would be very foolish for them to use a Gaussian distribution. So they deliberately adopted Mandelbrot's stable Levy distribution because they wanted it to be counterperformative. In other words, they adopted a model in which terrible things can always happen in the hope of reducing the actual probability of terrible things happening. In other words, they wanted to create a world which was the, as it were, the opposite of the world posited by the model, and that's what I mean by counterperformativity. And yes, absolutely, I think such processes are important.
Thank you. The other questions? No. Okay, maybe we could stop here.
Yeah.
And thank you again, Donald.
And now you have your votes, aren't you?
Yeah. Votiamo per il premio.
Sì.